beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Taiwan index holding on to gains of 0.7%. PM Modi's visit to France includes an extensive discussion with Macron on strategic cooperation, innovation and artificial intelligence.
I think this is going to be one of those years when the offtake in the state capex loans is going to be at its lowest point.
Nifty Bank closed lower yesterday, but relatively outperformed the Nifty, 23,365 and 49,871. Nifty Bank is coming off a little bit more.
10% increase in volumes for Congo, which is cardiac, oncology, orthopedics, neuro and gastro.
We do want to come out ahead of the industry growth and continue to maintain our lead.
साल 2030 तक हम 500 गीगावाट रिन्यूएबल एनर्जी कैपेसिटी ऐड करना चाहते हैं.
The sell-off is now extending itself for the fifth day in a row.
The rupee at its sharpest dealt at 86.63.
It seems like even the strategics are refocusing on India.
There's a lot of conversation about recalibration and strategy.
The meet is expected to drive investments worth around 10 lakh crore rupees across sectors.
Mid-cap index down 3.4%, small cap index down close to 4%.
Well, it is painful, and we are almost at 23,000 now, 23,028 on the Nifty. This is closing bell. We are starting a little early, of course, because of what's happening out there in the market. I'm Prashant. With me, my colleague Surabhi, Rima here, and Nigel joining in from the newsroom floor. Guys, hi, good afternoon.
Hi, afternoon. The mid-cap index is down 3,000 points in a span of 2 days, 1,800 points lower today. And add to that the near 1,200 point fall that we had yesterday. 5.5–6% gone on the small cap index in 2 days. So this is really going to test the patience of the new investors who had only seen gains.
You know, so I'm sure most of us have been trying to figure out, calling people as to what's really going on. Some feedback that I received was that this doesn't look like mutual fund-based selling. It's not MF suddenly throwing in the towel. It's not that. It's probably more to do with, either individual traders or retail investors or, family offices. There's a large middle which is not captured. It's neither FPI nor domestic institutions. They're not, domestic insurance firms or mutual funds. That large black middle is leading to this kind of a fall. At least that's what I'm picking up. Because the sense and the sentiment seems to be preserve money wherever you have it. And a lot of these mid-cap stocks have run very, very hard. So one theory that I heard was it's preserve profit wherever you have it and get out. And the second was start booking some losses, because remember, you can offset your losses against, gains elsewhere. So maybe there's some kind of rejigging going on, but painful would be an understatement. 2 days running, extremely severe. Nigel?
Well, that's right, one would say that the weaker hands are getting flushed out, but just take a look at the pain in the broader markets. There's a lot of pain out there, and that was where the big money was made by a lot of retail audience. So that's why we're seeing a bigger sell-off out there. That's the broad feedback you're getting. It may not be institutional-led, but the kind of selling that you're seeing from the HNI's larger participants as well is quite a bit. The hope is that maybe we at least protect the recent low, which was at around 22,780 or thereabouts. So let's see how this goes. The problem is these tariffs. The US is talking about something. Now you have the European Union that's responded as well. And it could turn into a whole-blown tariff war, which in turn will be very, very uncertain for the global equity markets as well.
Absolutely, and we'll hear more on that. By the way, as we get into the program, we are at 23,000. So let's see if we are able to hold this. That's basically nothing but the 20-day moving average. 23,004 as of yesterday's close, and we are at the 20-day as we look at the picture. But that's 1.5% on that index. Other indices are down 3%, almost 4% on the small cap index. So everything down kind of a day. Quite something. Let's bring in Rohit Srivastava, founder and strategist at IndiaCharts.com. Rohit, good to have you with us here, but we've seen markets puke it out all out. I think that's maybe the one expression which passed through my head. It does certainly seem that way. What's going on in your opinion, and where are we at? The bounce has not been that sharp on the up. So we got to about, what, 23,800 or so, which was the low, 27th of January. And then the market bounced a little bit. It was expected, broadly the view was it'll maybe stretch a little bit more. But we reversed much faster. Where are we at, and where does it leave us?
Yeah, surely the quick reversal to the downside has probably been a surprise, because you've been at the end of a 4-month-long decline. So let us split this view into two parts. One is the medium to longer term, and one is the short-term setup. Medium to longer term, I think since October, I've been anticipating what could end up being a year-long grind, which we may eventually end up calling a bear market. But it's essentially that you don't make new highs. You have many bear market rallies, you have sell-offs, and so on and so forth. So that is like in the big picture. In the near term, however, nothing happens one-sided. So if you had a pretty long fall over several months, you do anticipate that some kind of a counter trend move would happen. And that is the setup with which we were working, I think, from the week prior to the budget. And you're right that we didn't get past 23,800. And once again, we are back to testing the lows. My sense is that we are getting very oversold today, especially when we look at certain indicators, like we have our daily swing indicator, which essentially tells us the percentage of a group of F&O stocks which are showing negative momentum, and that's down to around 3%. So when you have only 3% of stocks showing positive momentum, 97% negative, that's usually a point from where markets will rebound. That doesn't mean today itself, but being very, very close to that point today, tomorrow, and you start recovering again. And what I would then anticipate is that we manage to protect the lows of late January, which is 22,800, or even better if we protect 23,006, or which is around 78.6% retracement of the bounce that we had seen. Then we should make one more attempt to go towards 24,000. So that is the first thing I would think about. Can we really make that attempt? Because nothing has really happened in the global markets to cause this kind of sell-off, and we need to also come out of some medium-term oversold conditions. Like a lot of us have talked about the positioning, which is the FIs being extremely short, the client data being extremely long, and they are at the opposite ends of the spectrum. And whenever that has been the case in the past, we have seen markets turn around for some time. And that has not happened yet. We haven't seen any significant short covering. Now, we can argue whether this is directional and the market keeps falling. Definitely, markets are supreme and it's possible. But based on data and based on historical patterns, we wouldn't anticipate that right away. I would expect that markets try to bounce back, loosen up the negative sentiment much more before you get another meaningful sell-off. However, the hard part would be to say the same thing about mid caps relative to large caps. I think that is where the next debate shifts then. But these are the nifty levels with which we'll be working, and still looking for that it does not significantly sell off yet. You might attempt another recovery into March.
Rohit, hi, afternoon. So that's the near-term outlook, right? That we've possibly made a bottom today, tomorrow. There will be a little bit of a bounce back, maybe another meaningful correction. But what about the trend in the market for the next 6 months, 9 months, or 2025? Are we in for, much lower levels? Broadly, directionally, are we headed down? If you look at it from just a larger time frame, and talk to us on what's happening on the mid and the small cap stocks.
So when we take a slightly long-term, longer time frame, we've, historically, when we would go into a market correction consolidation, we are used to the idea that, Nifty, mid-caps all generally move in tandem. But 2018 to 2020 was a very, different period, which, changed the way the market behaved. And it did so also in an environment where we did have a lot of mutual fund flows starting. That was the starting point of your mutual fund Sahi Hai campaigns. And so all that money kept the large caps elevated even when the mid caps were falling. So that is the main thing to remember. 2018 to 19, 20 till COVID happened. The Nifty was still holding up, coming back to 12,000 after each sell-off. But the broad market was still in decline. I think that is the first thing that we can at least anticipate, that there may be further weakness in mid and small caps. After each bounce, they may still keep selling harder as we are seeing today. But somewhere the large caps may find support because money in the end has to go somewhere. A lot of money is flowing into funds. They will only reallocate. They will decide, okay, let's not buy too much of mid cap. Let's buy this. They're hybrid funds that will shift back and forth. And so at some level, you end up getting buying coming back to the large caps. And so that may be more supportive of Nifty, Bank Nifty, relative to mid and small caps. So that is the first scenario we should keep in mind. What happened between 18 and 20 can repeat. The alternate would be to have something like 2015 or 2012, where for a 12-month period, both Nifty and mid caps made lower lows and lower highs, and you gave up around 20-30% over a 1-year period. That is the second scenario. But I think given the similarities and more recency, the first scenario has a greater likelihood of playing out. But we will see as it progresses. It clearly highlights one thing, that be careful of mid and small caps. I think that much is clear.
Absolutely. Rohit, hi, good afternoon. I was actually doing homework for the other show that I also host, the Personal Finance Show. And since the pain in the mutual fund part is also really showing up, people are asking, it's all very fine to say long-term India story, but the thing is people still pick up their, funds and look at the NAVs, and they're down quite sharply. Maybe I'll put up this data for, everyone's reference. The mid-cap category, mid-cap funds is the category, in the last 3 months is down about 8%. The small-cap category is down 10.5%. That's 3 months. And not just this, the 3-month correction has been so savage, it's cut out the whole year gain as well, down to about 7% gain average in small cap funds, which is, people will really, sit up and ask questions. Is the risk worth it if my 1-year return is coming down to 7-8% now? Of course, these are absolute returns. They're not rolling returns. So we have to take that in perspective. But Rohit, the question is, what is to be done here? I think, and that's something that people are grappling with. Now, whether you're owning mid and small caps directly or via funds, would you say that this is the time to book whatever profit you have, or do you think that this is the time to just sit tight in at least some sectors and companies? What's the advice? What should be done with anyone's mid and small cap holdings? Anyone who's watching this absolute carnage play out?
So what has to be done is that every time you get a bounce, like we got one in December also, where the small cap index almost made it back to the highs. This time around, it was much smaller. Every time we get these 2-3 week rallies, you need to reduce your weightage towards mid and small caps in favor of large caps. Now, this is usually not true for individual investors who have only, say 10 stocks or so, and they've selectively bought something which they have a 5 to 10 year time horizon for growth. Then it becomes a different game. But when you're really investing only in funds and you're watching 6-month, 1-year performances, it makes a lot of difference if you have over allocated to a particular segment, which most people are saying is still relatively overvalued. So reducing that weightage in favor of large caps or particular other sectors that can do well in the interim might be one way to deal with the problem, because otherwise you'll keep seeing poor performance or even negative performance stretch further on a 6 or 12-month basis, because this segment might continue to weaken in this time period. So that is the thing to keep in mind. And second is also consider alternate asset classes. Very few people talk about. One of the places that have done well has been gold, and gold as an alternate allocation apart from equity is also something that a lot of investors should consider during such times.
Hi Rohit. Rohit, I wanted to ask you about the Nifty Bank. That in fact has taken a sharp downtick. It's at around 49,300. One would have thought a sector where there is valuations which are pretty okay. You have RBI action as well that's taken place, and bulk of the estimates, going ahead as well, they don't appear very, unbelievable, or they appear that they've taken into account yields will fall a little bit. But that one, in fact, is at a very, very crucial level. Where is that one headed?
Yeah, so like you said, it's a crucial level. If we look at all the major indices, it's one of the ones that is losing the least. The Bank Nifty, it's down less than the Nifty. It's not broken the 20-day average, which is currently at 49,272. So it's actually doing relatively better. Of course, it's down because the market is down, and so everything is down. But on a relative basis, if I look at the performance from the 5th of December when the market peaked, the top sectors that we actually see I see on the screen right now is private banks. That is one that comes right on top, followed by IT, banking, and metals. So these might be the areas. So when you see on a decline like this, that these are the areas where we are seeing relative outperformance. That is sort of where I would expect things to remain better when even the markets rebound. So they would be places where I would look at allocating money at this point of time from a maybe at least a 1 month perspective.
Okay, so again, the view, Rohit, is large caps see a bounce from here, maybe the Nifty, right?
Yeah.
Mid and small caps can't say. You're saying institutional behavior could move towards large caps, and that may cost mid and small caps, right? Because you've got to, I mean, you basically mark to market to the benchmark, and then you can't, it's tough there. Individual, of course, portfolios, that's an important point, the differentiation. And sectorally, anything looking, interesting or poised for further declines?
Further decline. So one of the surprisingly most weak segments is FMCG. I think we all thought, including myself, that post the budget it would hold up a little longer, maybe go further than that. But it's broken that entire shelf. The FMCG index, the Nifty FMCG was holding 55,000. It held it around 3 times between late November and mid of January. And after attempting a breakout on the upside, it failed. And now it's making new lows. It's broken the entire range. So that looks like a very, very weak segment right now, despite whatever we may have tried to do. And it means that that's going to keep making lower highs and lower lows. So even when it does bounce, I doubt it will possibly go back to even where it was, pre-budget or around the budget. So that's one of the weakest areas I can see.
My question was weak or strong? Anything looking interesting also from a buying perspective?
On the strong side, I would actually think metal space, even though I know the tariffs that have come overnight are on steel and aluminium. But when you actually look at commodity prices, they are rising. The copper prices have been going up for the last 6 to 7 days consecutively. Aluminium prices are close to a breakout point. So they could very well follow copper on the way up if they go past around, say, 2690. That would be a good breakout point above which aluminium would get strong. Even there are other commodities, things like coffee, which nobody's looking at, which are making all-time highs. So basically what I'm saying here is that commodity prices, and sometimes this is how cycles work. It's bonds, equities, commodities. Bonds tend to peak out first, equities next, and then commodities are last. And so money does get reallocated from equities to commodities in a last blow-off, and which is why sometimes inflation risks remain elevated till later in the cycle. And we are seeing now some kind of a pickup in commodity prices. So commodity-related stocks could be another area which could be positively surprised.
Rohit, thank you very much for that. Just a word on gold. There are two, game-changing events that everyone's watching out for. One, is there a possibility that the US Treasury will revalue its gold assets? So it's currently valued at $42 per ounce, but the current market rate of gold is about $2,900 an ounce. And increasingly, there is speculation that the US Treasury will revalue it at the current market price, which basically reinforces confidence in gold as an asset. And secondly, China has allowed a pilot program which allows insurers to invest in gold. So it takes money away from the US dollars and it will put them in gold. And that again could drive gold prices. So that's just a quick update on gold. But let's move on and talk about the broader market and the panic, the big sell-off, the mayhem that we're seeing there. Now, FIs have sold shares worth 1 lakh crore rupees in 2025. Sudarshan is here with the numbers.
So market has taken a big knock in the last few days from their recent peaks, especially in the broader markets. Both mid-cap and small-cap indices are down nearly 20% each. And in just last 2 sessions, both these indices, mid-cap and small-cap index, are down 6% each. So what would be the main reason? If one of the many reasons, if you could mention, that is big FI selling. Just in 2025, basically in January and in February, if you accumulate, FIs have sold shares worth nearly rupees 1 lakh crore. And from October 2024, FIs have sold shares worth nearly rupees 3 lakh crore. Now, if you look at the mid-cap stocks, there are 100 stocks. So nearly 30% of those stocks are at or near to 52-week lows. And all the stocks have fallen up to 60%, with 60 or 70% of them have fallen more than 30%. Now, for Sensex and Nifty, fall from their record highs are in the range of 11 to 12%. But look at the broader markets. Mid-cap index from record highs down 17%. Small-cap index has fallen 19%. Nifty Next 50, earlier it was known as Nifty Junior, it's down 22%. And Nifty SML 250 is down 19%. And if you look at the sectoral indices, the fall is more severe. Media index down 32%, energy 30%, PSU 28%, realty 26%, PSU bank 26%, and metal 20%. Now, if you look at all the stocks, obviously PSU stocks are topping the list, with top losers being MRPL down 60%, Cochin Shipyard 55%, Vodafone Idea 54%, Hind Zinc 49%, Oil India 47%, Hoodco 46%. These are the stocks in the mid cap. If you come to the small cap, Sterling and Wilson 64%, Chennai Petro has fallen 61%, Raymond is down 59%, Jupiter Wagon 57%, Titagar Rail 56%, ITI 53%. So now, what's next from here? There was an expectation from earnings that also seems to have vanished. Number of companies which have reported earnings so far, so number of companies reporting below than expectations is much more than the companies which have reported earnings which are higher than estimate. So we'll have to see how the next few days pan out. As of now, it's a big fall that we are seeing in the market.
Okay, all right, indeed. And a lot of these stocks have fallen in a big fashion from their highs. So Darshan, thanks very much. That's interesting data. Just puts the fall in perspective for us. We have to slip into a quick break at this point in time, come back with some more perspective. And we'll have Adrian Moat join in as well. He's been a long time India veteran watcher. So what is he making of the Indian market's underperformance? Back with that in just a bit. Welcome back. We're continuing to track what's turning out to be another brutal session for the market. 3.5% gone from the mid-cap index. The Nifty is nursing losses of about 1.5%. We have now, as promised, Adrian Moat joining in this leg of the conversation. He's someone who's been watching India, tracking the Indian market for many, many years, for decades. And therefore, that perspective is going to be very useful right now. Adrian, great to have you on. Thank you for taking this quick call. You know, investors in India are not really used to long periods of underperformance. But that's exactly what's playing out now. The growth valuations are perhaps coming back to haunt us. What do you make of the big sell-off that we're in the midst of? It's been a time-wise correction, but now the price correction is also getting pretty savage, especially in mid-caps and small caps.
It certainly is. And, you know, when you look at the charts, the technical situation looks very poor. And I was just looking at how even the Nifty, you know, failed to break above its 50-day moving average, is moving down, and then we've got another sell-off. So there doesn't really seem to be any sort of technical level for the market at this point in time. And you know, if you go back to your earlier point, which is the valuation of the market, this remains a very expensive market, which is justifiable if it is generating high growth. And I think investors have been disappointed both at the macroeconomic level, but probably more importantly at both revenue and profit growth levels in the market. So this is going on against a backdrop of India being a big outperformer, emerging market funds having a good exposure to India, at a time where we've got rising U.S. interest rates, which put pressure on current account deficit countries, including India. And we've also, surprising, considering you'd think it would be the center of the trade dispute with the United States, Chinese equities doing quite well at the moment. So I think that the mindset here for investors is, look, I've been long an expensive market. It's not delivering the level of growth I was expecting. And at the same time, I'm very underweight market like China, which is surprising me by performing well. That might be partly driven by the whole DeepSeek story and people perhaps appreciating the level of opportunity in very cheap Chinese tech names.
You know, the funny part, Adrian, is that all this, if we, for instance, talk about the latest rumblings, which is all about tariff and tariff wars, if anything, I guess markets like South Korea or Taiwan or, of course, China, they're directly more impacted. India is still a very inward-looking market, and our net exports to the U.S. are not that significant in the larger scheme of things. Yet, like you were saying, the Chinese market has started doing better. We're not seeing a big shakedown over there. So in the near term, do you think that could be an added negative for India? Should we be prepared for that China starts doing better despite these trade wars?
Well, I mean, it is doing better despite the trade wars, and I think you are already seeing a flow impact. Remember here, we're talking about the Indian equity market as opposed to the Indian economy. Your IT sector is very sensitive to U.S. immigration policy, and there's clearly a dispute between, let's say, the heads of the big tech companies and those that are more MAGA-centric about whether visas for skilled workers should be given out. And if they're not, that is pretty bad news for the Indian IT industry. You've got a lot of steel companies and commodity companies listed, and if you're getting tariffs on the import of steel and aluminium into the United States, there is an impact at a sector level there. But I think a lot of this comes back to just the results season. The results season was disappointing. And when you're an expensive stock and you disappoint, you are going to see share price corrections. So I would suggest quite a lot of this is micro. It's about the earnings disappointing relative to the valuation.
You You know, there are so many stocks which are at fresh 52-week lows. Swiggy, Delivery, MRPL, Motherson Wiring, NCC, LIC, GAIL, Coal India, IOC. All these stocks are now hitting fresh 52-week lows. And these are stocks which have fallen 35, 40, 50% from their 52-week high. So, Adrian, what's the advice that you're giving investors now? Sell more of Indian shares, or do you think now, after the correction, there is some relative comfort?
I wouldn't be buying at this point in time because you need to... You know, as we've seen, let's say, in markets like China, when, you know, the share market peaked a couple of years ago, the correction phase can be quite protracted as valuations move back to, you know, the growth to a level that would be justified by the growth rate that they're delivering. I think the retail investor in India has a large exposure to equities. They've done well out of it. And now they're going into a period where that exposure is beginning to hurt them. And they might be willing just to, for a period of time, park a bit more money in the fixed income market as opposed to the equity market. If you're a high frequency trader, I would still be on the sell side. As a saver, I would be standing back and not buying into this weakness.
Okay, I would not be buying into this weakness at this point in time. Adrian, it's a pleasure. Thank you very much. And I hope you come back and speak to us once we know what really comes out of the sort of, you know, talks between President Trump and PM Modi. That's essentially going to be over Wednesday and Thursday. And I think markets will remain very, very sensitive to it as well. Thanks indeed. Well, sorry, go on. You wanted to say something?
I'm sure the President of the United States will say they're the best ever talks he's had.
But do you think it'll yield a positive outcome from an India perspective, or you think at the margin, you know, whether it makes a real dent or sentiment-wise, you think it'll be positive or negative by the end of it?
I think for an hour it'll make a difference, and then there'll be another news story coming out from the White House. You know, I'm getting to the point where I think we're better off watching cricket rather than Trump's Twitter feed for our own mental health, and probably for the performance of our portfolios, because I think it's very dangerous reacting to all the noise that's coming out.
No, absolutely, and it's been overwhelming. Is the Twitter feed, and of course then there's the other stuff, and it doesn't stop. I mean, Saturday, Sundays are not sacrosanct either. And you hear something or the other over the weekend when you come back on Monday. Thank you very much, Adrian. Appreciate you joining us here on CNBC-TV18. I think, you know, the market just about holding the 23,000 mark, 360 odd points down in the Nifty. So that's opinion, both local and some global stuff as well.
The thing is, by the time an executive order goes out in the evening, 11, 11:30, you never know. By 6 in the morning, maybe a part of it has been repealed, or someone else has done something else, or there's another tweet putting it on hold. So, I mean, this is an extremely exciting time, if I were to say optimistically.
Exciting for the news cycle. Absolutely. For news cycle.
Exciting in double quotes. Okay. All right. I think we have to take a very, very quick break. As we do that, let's get you some more snippets from the Growth Code. This is, of course, an initiative by Grow and CNBC-TV18. We want to leave traders with some essential tips and strategies. Here's a snippet of what Saket Ramakrishna, trader and founder of Quick Alpha, had to say about common misconceptions in the trading world. Listen in. We'll take that break and come right back.
What are the tips that you would like to give in your experience as a trader and now an entrepreneur to the young traders who are looking to venture into the markets?
So firstly, it's mostly about having the right mindset. So most of us are here without understanding what trading is for quick money. So just because we have seen in a lot of places where people have made, they post that they have made quick money, and also It is, on the other hand, a business where people sell dreams. So they sell tips, they sell courses, they sell a lot of things where they themselves are not making money. But they sell dreams of making money, and due to which a lot of people get lured and they get into this process of making quick money.
What are the common misconceptions that you would like to bust through this platform of these young traders and enthusiasts?
So first, going by the statistics, so mostly when you come to markets, you would be among the 93%, but not the 7% who will actually end up making money, right? So when you come into the markets, unless you're coming into investing, don't come with a hope that you will actually be making money. So try to avoid as much as social media noise and try to focus on the basics of it.
Tell us about your journey and what are the ups and downs that sort of you took a lesson from.
What really happened is, for my first almost 1.5 to 2 years, I only saw the market go up, because when I entered, I think Nifty was around 5,400 or 5,500. From there on, 2014, we had the election and market saw a fantastic bull run. By 2015, when I was into market, so I already had started F&O by then, right? So I had only seen a bull phase where the markets went from 5,500 all the way to 8,500, right? So in my mind, it was never that the markets can actually fall.
Welcome back. Well, the markets continue to reel under pressure. If you're, trying to look for a couple of positives today, one is the rupee, which has pulled back a little bit. That's point number one. Point number two is, in the last 1 hour or so, at least the Nifty has managed to defend the 23,000 odd mark. And point number three is the Nifty Bank. If you pull up the 20 DMA as of now, it breached it intraday, and now it's holding about that. And for the next, 50 minutes or so, you'll want these levels to hold out, which gives the bulls a chance to fight for another day as well. So that's at least the hope. It's a weak trading session, no doubt. Mitesh Thakkar is back in. Mitesh, you had told us you have taken your long positions down, but have you all started shorting the index now? Are you bracing for a bigger pullback as well from these levels?
Oh, we have. So, instead of the long view has gone wrong, then I was hoping that there could be some consolidation, and the markets have actually broken the 23,200 levels as well. So there's no sign of reversal, and I don't want to take a shot at these levels given the fact that we are slightly unfavorable risk reward equation kind of result. So we've got to wait it up for the next opportunity. Till then, I think trading should be slightly more on the stock specific basis. I have a sell on Tata Communications. Keep a stop just about levels of 1550 here for a 1450. 1460 kind of a target. Similarly, Tata LXI is also giving a fresh negative crossover. So sell here at the stop at 6200 for targets of around 5940.
You just apologize to him.
Okay, all right. Mitesh, got it. Thanks very much for the calls. We'll come back to you in just a bit. Let's move on and look at some stocks as well. The market, of course, as a whole has been pretty troublesome. Nifty is still trying to hold on to 2,300 for what it's worth. Like I said, let's come down to some stocks. One of the worst hit on the Nifty is actually Eicher Motors, or even we should point out Apollo Hospitals. Apollo is now down 6.5% after a pretty decent quarter. But I think maybe it's the added weight of the Adanis getting into the healthcare space. Maybe it's that. Maybe it's just the general market sentiment. Big knock on Apollo Hospitals. The other one which is falling as much as this is Eicher Motors. So what's plaguing Eicher? Clearly the numbers haven't gone down too well with the street. Sudarshan's joining in with more details. Sudarshan, margin was?
So Eicher Motors is top Nifty loser, and it seems that market is concerned with the same issue that we have been highlighting since morning. That's about the margin. It's about what would be the level of the margin that company would be comfortable with. Now, remember last quarter after Q2 earnings, company had raised this issue that it would prefer growth over margin. And you can see that over the last few months, volumes have been healthy. Every month, company has been reporting volumes of more than 90,000 units. And in Q3, total volumes were up 19%, up both sequentially and year on year. But what about margin? Margin for Q3 has come in at 24.2%. which is down 200 basis points year on year, also down against our expectations of around 26.4%. And some of the factors which have impacted the margin is the adverse product mix. Nearly company had launched one product that is Bullet Battalion. It's a low margin product, and it might be helping the volumes to go up, but on the margin front, it's impacting negatively. And another is, due to heightened competition, companies unable to take price hike. So these are some of the major reasons. That's the reason that margin has been under pressure. But company will have to take a call. What would be the level of the margin that it's comfortable with?
Today, while UBS is downgraded, Eicher Motors posts the Q3 numbers. Morgan Stanley says growth over margins is the right strategy, but with the stock pricing in high growth and high margins, achieving both will be tough. Their target price is all the way down to 3,855. But Sudarshan, Escorts Kubota, also very weak set of Q3 numbers. Commentary here was downbeat. Give us the details. Sudarshan? If you can hear me, tell us about Escorts Kubota.
Well, Escorts Kubota, it was an all-round miss. On the earnings front, company has performed much better than, much below expectations on all the front. Revenue was below estimates, when margin has come at 11.4% against our expectation of 12.4%. But more than earnings, what has been more problematic is the guidance. Guidance that company has given for FY25 is very weak. On the volume front, it says that due to the transition, it's going to increase the construction equipment price, and in resultant, it would impact the volume. And second, company has been also unable to take the price hike. And on the margin front also, it says there will be a gradual increase, but companies unlikely to see a major jump in the margin. And on profitability for FY25, it's saying that it's unlikely to see any major change if you compare versus FY24. Now, if you remember, yesterday only M&M had come and it had given the guidance for tractor industry that in FY25, growth is likely to be in the range of 6 to 7% for FY25. And that means that in Q4, growth of tractor industry is likely to be much more than 15%. But it's for the industry. We'll have to see what exactly it would be for Escorts Kubota, because on volume front also, every month, the volume that company has been reporting has been below expectations. So results were weak, but more problem is the weak guidance.
Okay, thank you very much for that big crack seen in many of these auto names. Realty Index is the worst performing index today, and that we'll get that up for you on your screen. But ahead of Axis Capital's India flagship conference this week, Neelkant Mishra discusses the potential fallout of the US reciprocal tariffs on India. And Atul highlights the risk of high equity supply in 2025.
While there is a lot of global turbulence, the levers for growth are completely internal. So there will be some impact. As we have estimated, if there are reciprocal tariffs, and this was done before the headline rates were cut in the budget, if US was to impose the same rates as India imposes on US imports, you would see an impact of about $7 to $8 billion. But I think that number is going to be a lot lower because India, as you must have seen in the budget, has actually cut those numbers. There is, I think, significant global uncertainty. I think there is, the more the uncertainty on investment. And therefore, it makes sense to be a bit cautious on external demand.
23, we saw total activity of around $15 to $18 billion. In 24, we saw around circa $40 billion. In 25, we could see as high as $50 to $55 billion of sale through various corners. So that's the supply that is going to hit the market. As long as we have the domestic flows which are robust, and there the key indicator to watch out for is the SIP flows. I think as long as the SIP flows are adequate or in line with what we are seeing, we have no reason to be worried or concerned about.
amazing. There are many biases that we need to think carefully about. That is why I'm grateful to my friend, President Macron, for hosting this summit and for inviting me to co-chair it. Friends, AI is already reshaping our polity, our economy, our security, and even our society. AI is writing the code for humanity. AI is writing the code for humanity in this century. But it is very different from other technology milestones in human history. AI is developing at an unprecedented scale and speed, and being adapted and deployed even faster. There is also a deep interdependence across borders. Therefore, there is a need for collective global efforts to establish governance and standards that uphold our shared values, address risks, and build trust. But governance is not just about managing risks and rivalries. It is also about promoting innovation and deploying it for the global good. So, we must think deeply and discuss openly about innovation and governance. Governance is also about ensuring access to all, especially in the global south. It is where the capabilities are most lacking, be it compute, power, talent, data, or the financial resources. Friends, AI can help transform millions of lives by improving health, education, agriculture, and so much more. It can help create a world in which the journey to sustainable development goals becomes easier and faster. To do this, we must pull together resources and talent. We must develop open source systems that enhance trust and transparency. We must build quality data sets.
All right, that's Prime Minister Narendra Modi sort of addressing the August audience there. And of course, his next stop is going to be the US, where all eyes is going to be on Prime Minister Modi and President Trump as they engage in talks. Tariffs top of mind, and that's going to be all of the sort of news cycle over the next 2 days, Wednesday and Thursday. Jitendra Sriram is with us, Senior Fund Manager at Baroda BNP Paribas Mutual Fund. Jitendra, good to have you with us here. Thank you for your time. You know, the screen is negative, so the price makes you negative even if you want to be a little constructive or positive, but you must look through it. If you have time on your side and if you have money to invest. What are you doing, Jitendra, and how are things looking? Is it looking so negative, or What's the view here, from here?
Yeah, so broadly, I would say I think the correction has been quite intense and quite rapid as such. So I would think that at this juncture, it actually looks like it is a little bit overdone for near term, because at least from what we can see on the capex front, the reports that we are picking up, at least the capex on the ground from the governmental sources and all, seems to be picking up. So our take is that at least the earnings momentum should improve from here on. So the kind of, we were undershooting on the earnings estimates all through first quarter, second quarter. My take is that we'll probably be closer to expectations, at least on the large cap odd side. Maybe the small cap still has about a quarter or so to go before it starts recovering. But I would think that at least certain segments are starting to look far more attractive now.
So which would be the sectors where we will see earnings growth revert, where there is opportunity sectorally? And where are the small cap pockets where you think that the recovery is a little more delayed now, 1 to 2 quarters out?
So I would say that broadly, if I look at it, at least the exporting segments is something that we are clearly seeing some kind of better traction come in, because, a lot of their pains were early on. So whether it's healthcare, whether it's IT, all these segments are starting to look a little bit more promising. There is a margin uptick that is expected by the street going forward. So those are areas that are clearly positive. The second is also that the Madam FM has put in a lot of money into the hands of the middle class now post the budget. That impact will be starting to felt through from April onwards. So hopefully that should also lead to some amount of discretionary pickup going forward. And that will again be an area where you could see some improvement and uptake coming through on the consumer discretionary side. So those are areas that are clearly looking positive. I would say that, where it could still take a little bit of time is especially those exposed to some of the capex thing, because capex, what is happening is a lot of the announcements are happening right now, but it might take some time before these investments are crystallized, move on the ground, that secondary order giving out happens. I think that might be a little further out then.
Okay. Jitendra, hi, good afternoon. Slightly different question, because I've been sort of trying to figure out how mutual funds are looking at this big fall and, what's the sense. The monthly data is going to come out only tomorrow, but I think the sense that I got from a couple of people is that it's not like suddenly the investors are shutting off the tap and flows are drying up. But what have you been hearing at your AMC and around in peers in terms of redemption pressures, especially for mid-cap and small-cap funds?
So it's very similar to what the news coming to you, in a sense that there is no panic as such on the retail side. See, retail is also confronted with a couple of things. On the tailwind, of course, you have this big rising equity cult which is there. The second is more money in the hands of consumers. All these are pro the equity theme overall. Of course, the headwind is that, in some of, especially like SIPs into, say, the small cap segment or something, you are seeing now the 1 year return being, say, probably about negative or something like that. So you could have a little bit of a headwind there. My take is that, the retail has also evolved over a period of time. They don't panic as much as they used to in the past. So I would assume that they would probably ride through it. And we are not seeing any, any kind of material, people pulling out money or something like that. What we are seeing is that, okay, the positive trickle that used to come in, that has probably, marginally come off, but it is still a positive.
Okay, all right, Jitendra, I request you to stay with us. We're going to come back to you. We want to continue this chat, but for the time being, it's 3 p.m. and we have Nimesh who's joining to tell us what he's making of today's fall. Nimesh, what's the feedback that you're getting? Sulpi earlier alluded to the fact that it may or may not be institutions, who are selling a lot, but it could be more the domestic hands. What are you picking up?
So, Nigel, 3 things which a lot of markets have been talking about and focusing on. One, is there a very large FIS selling? The answer to that is no. Okay. I haven't heard any large basket selling or an MOC sell flow at any large institutional desk. So, there is selling, of course, that's been the data which has been showing up, but there is not very large selling which suggests a 300-point cut on the Nifty or 3% fall in the broader market. So that's the FI part. Yeah. The second part is, are there redemption pressures in domestic mutual funds? Even to that, the feedback seems to be that there are no any signs of redemption pressures in the mutual fund industry, so to speak, as we speak, right? Good. The only thing is, from the DI point of view, from the domestic mutual fund point of view, the participation has slowed down clearly. I was talking to some large institutional desk, and the feedback is, if they offer or show a 10 lakh shares of bid, the bid is only for 3 lakhs or 4 lakhs. So clearly, from the mutual fund side, the aggression to buy in such a market is slowed down clearly. So even that is impacting the stock price to some extent. I guess what we are seeing is literally a carnage in the broader market name. So looks like that's more of panic selling from retail and HNI investors, or for that matter, who are individual investors who are directly investing into the market. So that's the pocket which seems to be panicking now. The mid cap index is down 3%, micro cap, small cap. The SME IPO index is down 4.5% in today's market. So that clearly shows that there is pain now at the portfolio level, and even at a trading level. So a lot of people are booking the losses as well to adjust the books for the March end. So it's still far off for the March end, but still, that's the feedback, that there is a bit of unwinding happening from the retail and HNI category. So that explains the flow perspective. FI large selling, no. Domestic redemption, maybe no. Yes, there is lack of buying interest from the domestic mutual funds. I guess technically, we've been saying this, right? 22,800 now is a level to watch out for. We've clearly broken the 22,300 support. Now the level to watch is 22,800. If that gets taken out, then you will see further selling or further panic in the large cap names as well. So that's overall feedback as far as flows are concerned. I guess it's more to do with the pain in the broader markets, and looks like that's something to watch out for. But again, looking at just the data purely from the PCR data point of view, it's come to 0.65, and I've been saying for a while now that that's the level where normally we see a bit of a pullback. So hope for a pullback, but I haven't heard any big selling from FIs.
There are two factors out there. One is the PCR, the other is the FI net short positions, which has reached 1.75 lakhs. So ideally, these are the levels from where we should get a bit of a bounce. That said, Nimish, what about individual stocks?
So in terms of individual names, the first is a couple of the new age plays, so to speak, Zomato and Swiggy. Both are under pressure today. In fact, there was a Citi initiating report on Swiggy as well, but stock is down 6%, and there is selling pressure. Aggressive selling is what I understand from larger FIs. I guess the street is a bit worried about, there could be a bill for the gig workers to be included in the pension scheme. So that could have an impact. And maybe that explains there is selling in both those names today. The second stock is Interglobe Aviation. In a weak market, that's not very down, but there is buying as well. There is small buying, but there is buy flows from larger institutions in Interglobe Aviation at these levels. But again, for Interglobe Aviation, watch out for a potential large block, because the 5-month lockup seems to be over now for the Gunball. So that's something to track there. The third name is Goldium International. A sharp cut in that stock, down 13% and large volumes as well. I understand there are sell-flows at HNI desk, and one leading HNI investor has been aggressively selling for the last couple of days there. And the last one is LIC Housing Finance. A lot of funds bought in anticipation of rate cut and a potential beneficiary, but now you're seeing a bit of reversal and a bit of, whether you call it profit booking or genuine selling, there is selling in LIC Housing at these levels.
Okay, all right, got it. Nimesh, thank you very much for that perspective. Interesting, the market that we are in the midst of. Back to that conversation with Jitendra Sriram, Senior Fund Manager at Baroda Mutual Fund. Thanks, Jitendra, for just waiting by. Want to talk to you about now the sectors that you're still convinced on, or the pockets where you think, despite this volatility, I mean, say 2, 3, 4 months down the line, 5 months down the line, at least one is reasonably sure of returns because of the growth profile and the valuation comfort. Where do you find these safety zones in the market?
I think utilities, as I mentioned, exporters was the first one, the healthcare, IT sectors. The second, I would say, is utilities is looking fairly promising. You had in the morning, you were putting out this thing about the kind of capacity growth, the kind of energy demand that's coming in the country as well. So those are something which are long-term drivers. So I know I can see that, there has been a little bit of a pressure of late, but I think the longer-term story is pretty much intact in these names as well. And also the cost of borrowing is a big help, because utilities typically work like an inverse bond as well. So to that extent, I would say that space is something interesting. And lastly, I would say even pockets of consumer discretionary should be promising. You have this huge amount of capital reaching out into the middle class. Where does it actually show up? is a little bit questionable. I mean, in a sense that whether it is used to buy a two-wheeler or a four-wheeler or something like that. But the fact is you have higher disposable incomes, which should be positive. I think sometime in the next year, we should also be starting to hear the news flow around wage commission awards for government employees, and then it follows through for PSU employees and all that. So I think you have a 2-year kind of a run of income boosters coming in for the salaried class as well. So that should also do fairly well.
Got that. Jitendra, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here on CNBC TV18. So that's a quick conversation with Jitendra Sriram. Markets down about 320 points. I mean, there is some recovery which comes, fleeting recoveries, but that gets sold into very quickly. I just saw the Nifty went on 280, back down to about 320. So that's what you've got going. Advanced decline is at the bottom of the screen. Some 10:1 more in favor of advances at this point. We'll take a quick commercial break here. More market conversation comes up. We'll get you more opinion from a private equity perspective as well when we return. Jay Bala will also be with us for a technical perspective. Stay tuned.
Not just the first woman banker, but the first public sector banker in India after 70 years of banking in this country to be awarded the Padma Shri.
I was really grateful and humbled. No other public sector banker has been acknowledged.
Do you believe then that privatization is the answer?
I don't really believe that is the answer. There was a particular reason for which the public sector banks existed. Women need to feel fulfilled. If you are fulfilled in doing, staying at home, being a homemaker, great. But do not think of it as a sacrifice. I would tell them that, it's good for you to be a role model to your child.
Welcome back. There's some tiny slight recovery, if I could call it that, in the mid-cap market. What was earlier a 3.5% cut is now about a 3% cut, but it's still brutal. There's no taking away from that. Let's look at the top volume gainers and see what's moved up in the last 1 hour or so. Not too many names actually on the upside, hardly any to speak of. Largely still names on the downside. Lots of PSUs, NBCC, you have names like obviously IFCI, SAIL, RailTel. It's a bad day, bad afternoon for most PSUs. Okay, let's quickly move on and get some final trading advice from Mitesh. Mitesh, it's been quite a session. Final levels to keep in mind for the Nifty. Clearly, the long trades haven't worked 2 days in a row. And any final stock ideas?
I think, the index trade hasn't worked. But, on the stock side, I would suggest STVT. That will be on APL Apollo. Keep a stop at about 1392 and look for a target of maybe 1350, 1345 on the downside. And the other one is STVT on Bajaj Auto. Here, keep a stop at about levels of 87.91 for targets of 87.20.
Thank you very much for that. Let's get some more opinion then on the markets, the Indian economy and investment. Venture capitalists and PE fund managers still remain very bullish on India. Kedara Capital's Manish Kejriwal says the second half of 2025 will be a buyer's market, while Samara Capital's Sumit Narang says the deal flow in 18 months should accelerate. Listen in.
A significant amount of dry capital, as we said earlier, for sponsors. And India being globally relevant, whether it's China plus one, given what's happening to the Ukraine and the Middle East, it seems like even the strategics are refocusing on India. So exits, IPOs, of course, but in addition to that, the financial sponsors, because of all the dry powder we have and because we believe in India, and in addition to that, the strategics. So as a promoter or a GP which controls an asset, our exit options for the first time are multiple and very attractive. Sharon, I think if you look at what was clear is the time gone by. So when I look at 24, it was definitely a seller's market. We had IPO markets which were crazy. We all got exits. I think each one of us, we had more than 4 IPOs. We still have another 3 in the... It's gotten tighter now. So when it's a seller's market, buying was very difficult last year. The public markets eventually are an indicator where the private markets are going to go. And it hasn't been the most healthy start to a year. I think prices rightly will correct. The multiples will compress. And the second half of 25 will be a buyer's market much more than a seller's market.
If you see globally, as investors sitting globally, still India is, I think, on the expensive side on a relative basis, what they are seeing. So I think the markets will be subdued. And I think to each seller, if people like, even in our business, if a business needs to be sold and we need liquidity, and we're getting 10% lower than what we want, we would go ahead and do it. And I see the same behavior from, other motivated sellers and buyers respectively. But I think it will be a little subdued environment seeking liquidity.
Welcome back. Well, the markets are still down, but at least from the lows, you've seen some kind of recovery on some kind of, up move, at least on the Nifty as well as the Nifty Bank. Jay Bala joins us on the show. Jay, you've been calling it, right, that the Nifty could test lower levels. But, going by the way that we have fallen and going by some of the technical indicators, do you think we could brace for a counter trend rally, or do you think it's going to be one way down?
It's never one way down, Nigel, and good to be here. I actually overestimated the strength of the counter trend move. I anticipated the market to touch somewhere close to 2400, but the markets have started caving in from 23,800 itself. So, it didn't allow opportunity to accumulate enough short positions on the index. So that's what the market it is. But, going forward, two stocks are going to be very important. One is Reliance, another one is SBI. Reliance, if it were to break 1200, not a good sign for the bulls. And I've mentioned that SBI has potential to cave in to somewhere close to 550. That will be dependent on what the stock does between 722 and 721. If the stock were to slice through like a knife on butter, then that's an indication that much deeper cuts are coming through, and that will have a very broad implication on the banking sector and the overall market.
Hi, Jay, good afternoon. It's turning out to be a really tough last couple of days. So, any individual level stock advice right now, or would you wait it out for the next couple of days to see where the market settles? Any stock trades?
Yeah, I have two bearish views on two stocks. One is Lupin. Lupin from 2400 hasn't, exactly declined in a corrective fashion. It's looking like a start of a reversal in trend. And it's bounced from 2,000 odd levels to about 2225 in a corrective bounce. So, and today's decline is pointing to much deeper cuts for the stock. So, as long as the stock trades below 2225 or 2230, I'll be bearish on the stock. And the other one is AU Small Finance Bank, and it's been a rank underperformer. And the recent bounce from the January lows is sporting a corrective look. So as long as the stock trades below 620, I'll be negative on the stock and expecting more cuts to come through for the stock.
Okay. So got that. Those are individual names. Jai, hi, good afternoon. Just to get the Nifty view, are you expecting immediately lower levels, or are you expecting a bounce?
Yeah, I'm expecting minor bounce to come through, not anything tangible or pronounced one. So a bounce towards 23,300, 23,400 is likely to be met with further selling. I think the recent low that we saw in January, 22,700, I think it's a matter of time before it breaks. And we have been projecting every week from beginning of October, end of September, that the June 4th objective of 24,800. Sorry, 21,800, the closing basis, and the intraday low of 21,280. So that's the higher time frame objectives. The supports lie at about 22,700, which is the immediate lows. And once that's taken out, the support comes at about 22,100, and then anticipating a direct acceleration to the June 4th low.
Sorry, I'm jumping from sectors to asset classes, etc. But gold, of course, has been on a tear, and you have an interesting view here.
Yeah, that's right. See, gold, I put out a note when it cost 27.26 on London's spot gold, that it's heading for record highs, and had anticipated that to go to record highs, but silver not to get followed. And the markets have done exactly that. But the objective of gold was about 2850 to 2880, but it's exceeded that and come to about 2900 and change. So what gold does in the next few days is going to be pretty important. If it were to cave in, like I'm anticipating the next 2 days, then that's very dollar bullish and likely to see a lot of strength in the dollar and has implications for equity markets. But if it doesn't respond to in a negative fashion, it's going to probably go to 3,000 plus, which I'm anticipating to come through at a later date. So it might come through much sooner if it doesn't respond today or tomorrow. So that's an important implication for risk assets, because that has a direct implication on the dollar.
Okay. The only lone ranger on the Nifty that's finding a tiny hint of green today is Trent. Imagine it's the only stock, and that's after a dropping of almost 40% from the peak. Apart from that, all other 49 stocks on the Nifty are negative. It's that kind of an overwhelming afternoon. That's Trent. It's managed to pull back finally. Jay, I don't know if you've been tracking it, but I mean, the fall has been hard to miss or ignore on Trent, right? Any levels to keep in mind here? Is there any reason to at all look at any of these high-flying erstwhile winners?
See, the problem is Trent is good in the long term, but it's probably got short-term corrections to work with. The bounces, likely to hold on for the short term only, and not something meaningful or pronounced. So I anticipate some bounce to somewhere close to 5,800. But if you look at the overall market structure, the mid caps are below the January lows, and the FMCG index is below the recent swing lows. So it's all indicative of broader market weakness. So Trent as such, I don't think it's got potential to outperform or deliver significant short-term gains.
Okay. All right, Jay, thanks very much for the advice. Stay on. We'll come back to you and ask some more questions in the next show as well. But for the time being, let's quickly recap what has been another brutal day for the bulls. India once again underperforming regional markets, and the mid-cap carnage has been painful and deep. The mid-cap index over the last two sessions, just Monday and Tuesday, has lost 5%. The small-cap index has lost about 5.5%. So it's been massive unwinding. I'll just quickly name out some of the mid-caps which have taken it on the chin today. And it's a long list of stocks actually out there. Godfrey Phillips, 9% down. KFin, 10.5% down. Uno Minda, Elecon Engineering, Zaggle losing 10%. Just lots and lots of names. Prince Pipes is down 8.5%, 9%. Many names on the downside. If you're looking at the volumes charts, then even here, Railtel, Lemon Tree, PFC, Ircon, NBCC, Zomato, Sale. It's just you take a dart and throw it anywhere. Chances are it's going to land on the red side of the screen. But for what it's worth, Prashant, I mean, the bulls tried to defend 23,000. I guess sentimentally, that's the only positive at least I can find today.
Yesterday, same time, we were 23,300 was the 20-day moving average, right?
Yeah.
And that went and... sorry, 23,000 was around 23,000 was the 20-day, and that's been defended. But the point is, we are off sharply, 300 points once again, and this week is already turning out to be a pretty bad one. The Nifty has lost about 2.5%, and I was just looking at the cuts in the small and mid cap indices. Small cap index is down 18% from its all-time high, with today's 3.5% cut. The mid cap index is down some 16% from its all-time high as well. So, we'll have to assess the damage in terms of individual stocks, what's fallen how much, and what percentage of, say, for example, a group like NSE 500 is down more than 20%, 25%. We'll do all that and sort of, get you an overall picture a little later. But once again, a poor day, and markets under a fair bit of selling pressure. It's a wrap on this edition of Closing Bell, but stay tuned. There's more coming up on markets forward. Surabhi and Nigel will take you through that in just a bit from now.